Hey, it's Robert Weinberg, and on this channel, we empower people to take control of their future through expert mortgage and financial strategies. If it's your first time watching, hit that subscribe button, smash the bell as well, so you get notified on all of our future content we put out every single week. In our lesson today, what I want to talk about is how to build wealth with your mortgage. You might be taking a second guess at why or how can you even build wealth with your mortgage, and that's what we're really going to cover. I want to open your eyes to some concepts and some ideas that can really open that door and show you new ways to deal with your money. So how can a mortgage be used to build wealth? There's a couple different ways. The first thing is equity. So every time you make a mortgage payment, some of that money is going to go towards interest, some of that money is going to go towards principal. The amount that goes to principal pays the balance down, which then increases your home equity. The more equity you have, the more wealth you have, the more opportunity that you have. You can also refinance your property, and we'll talk about strategies to do that. But by refinancing your property, you can build wealth because you can pay down debt, you can buy other investments, you can do a lot of different things by refinancing. Again, we'll get to that here in a few minutes in detail. Accelerate. So a lot of people look at a mortgage as something that they want to get rid of because it's such a big monthly bill. So you can accelerate the payoff of your mortgage by paying extra on it. There's some different strategies you can use in order to do that. And again, when that principal balance goes down, your equity level in the property goes up, which helps your net worth to increase. And the last one I want to talk about here is rent. So when I'm talking about rent, what I'm referring to is this new concept that's happened just in the last 5 years or so, which is people renting their properties out when they're not there, and other people renting their homes like one room out in their home when they do live there. So I'm talking about like either a vacation rental, maybe you're out of town, you can rent your home on Airbnb, VRBO, these sites, and you can make money that can help you pay your mortgage down or help you with other financial opportunities. Or it may be a scenario where you have a 3-bedroom home and it's only you live in one bedroom, and you may be able to rent one of the other bedrooms or a few of the other bedrooms out to people as a short-term rental type of scenario, or even on a month-to-month type of basis. So that's going to allow you to make money from your home even if you are living there some or all of the time. Again, it's all about building wealth. Now, what are the benefits of being able to use your mortgage in order to build wealth? The thing is, as your mortgage principal goes down and that equity goes up, we're going to be looking at opportunities to invest that money. What I see time and time again are people that have owned their home for years. They've never taken advantage of the concepts we're talking about, and they have all this equity built up in their home. Last I heard, the average loan to value in the United States was around 47%. What that means is the average home in America has greater than 50% equity in the home. Think about that for a second. 50% of the equity is left in the home. Why? Is there a better place that money could be used? There is, and that's what we're talking about here. But knowing these concepts, understanding that you can use your mortgage to actually invest in other opportunities is really the first or the tip of the iceberg when it comes to that. Another huge way to use your mortgage to build wealth is consolidation. Something we've talked about in depth on this channel, and I can tell you that consolidating debt into your mortgage is one of the biggest ways I've seen people build wealth, because you can save so much money by doing that. It frees up all this cash flow that then you can use to fund a retirement plan, give it to a financial advisor, maybe use that money to start a business or invest in somebody else's business. Just huge opportunities when you consolidate your debt and free up money every month, because it's really like almost creating money out of thin air, taking money that was going to interest on debt and redirecting it to investments and wealth building vehicles like that. Now, we need to make a choice here. What are you going to do? When we're talking about a mortgage, you are going to have to make that choice of, do you want to pay the minimum payment on your mortgage? Are you going to spend extra money on your mortgage? What are your priorities? So what I like to look at is something called a freedom point. It's what we refer to as have your cake and eat it too, right? So what the freedom point is all about is not really accelerating your mortgage, not spending extra money on your mortgage, but just making the minimum payment and taking all your extra funds and redirecting that over to an investment account, okay? So let's just say, for example, you have an extra $600 a month. Now you're going to choose, do you want to put that $600 on your mortgage to accelerate that, or do you want to put it maybe to an investment, right? So the real question that we want to look at is, how much are you going to earn on that investment, and how much is your mortgage costing you? So if you're looking at an investment opportunity that's going to give you, let's say, a 7% return on investment, right? Then you've got your mortgage, and let's say you refinanced your mortgage in the last couple years. Maybe your mortgage is at, let's say, 4% interest, right? So when you have that $600 extra here, where would you rather put that money? A guaranteed 4% or 7%? Of course you'd rather put it at the 7%. So the idea here is to make the choice of putting that money where it's going to benefit you the most. Once you put that money into the mortgage, you can't get it out very easily. You have to refinance, take a loan, that sort of thing. But if you put that in an investment account, and let's say 5 years from now you need access to some of that money, you can sell some of the investments or cash out that account and get that money a lot quicker and easier, typically, depending on the type of investment, than you would with your mortgage. So the idea of the freedom point is that ultimately, if you're investing this money every single month and it's accumulating $600 a month, $600 a month, $600 a month at a good effective interest rate, ultimately, you're going to have enough money in the investment account to completely pay off the mortgage. So if your mortgage balance, let's say, is $200,000, and this investment account has grown, and let's say the investment account ultimately gets up to the point where it's $202,000. So at that point, you have a mortgage of $200,000, you have an investment of $202,000. What you're going to do then is, you're going to take that $202,000 and pay off the mortgage at $200,000. That's going to basically wipe this to pretty much zero, okay? So you'll have just a few thousand left, if that. But this will be completely gone. This mortgage goes to nothing. So now at that point, you have zero mortgage, you have an investment account, and now you can take that money that you were putting on your mortgage principal and interest, and you can start redirecting that again over to the investment account and start the process over again if you like. But the whole idea of the freedom account is to preserve liquidity, to give you access to that money, because if you put it into the equity, if you put it into the mortgage, that equity's gone, like I said, unless you get a loan or go through the hoops that it takes to actually get access to it. So hopefully that resonates with you on the freedom point. The credit and debt to income ratio. So what does it take to actually qualify for a mortgage these days? Credit score wise, you know, I've seen loans done down to the 500 credit score mark, but usually you want to be in the minimum of 580 to 620 to qualify for a government-backed type of loan. If you're getting a conventional mortgage, then you want to be in the 620 to 640 range or higher. Those are just the minimums. Debt to income. So what we're referring to on debt to income is the total amount of your debt divided by the total amount of your gross income. That's going to come up with a ratio that mortgage lenders and underwriters use to figure out if you qualify. Generally speaking, we do want to keep that below like a 40 to 50% range, just depending on the type of loan that you're looking for, that you're looking to qualify for. But in order to build wealth with your mortgage, you do have to be aware and understand that you do have to qualify. Even if you have tons of equity in your home, there's going to be a qualification process that you need to go through, and you want to get with a mortgage advisor that understands these concepts to get you ready and get you prepared to take advantage of this if you're not already there. The last thing that we're going to talk about here in our lesson is mortgage strategy here and how you can use it to build wealth. So mortgage strategies that you'll probably have heard of are refinancing, like a rate and term refinance. So if your mortgage is, again, at 4% and then the rates drop to 3%, well, that might be a good opportunity to refinance and save you money on your monthly mortgage payment. By saving you money on that monthly mortgage payment, it again gives you access to more funds that you can redirect over to investments, retirement, business opportunities, all these other things, right? So that's the rate and term refinance. Also, reducing the term of the mortgage. If you have 25 years left on your loan and you can refinance down to a 15-year or a 20-year mortgage at a lower interest rate and also shorten the amount of time that you have to pay that mortgage off, that can be a great strategy as well. And then the other one is cash out. So there's a lot of different reasons why you would cash out equity on your home. The most popular ones right now are to buy another property, to do improvements on your current home, like renovations, repairs, that sort of thing. And of course, debt consolidation, paying off high interest debt and wrapping that up into the equity of your home, which can save you a significant amount per month, which then can be put to the Freedom account, to an investment account, to all these other places. So when you're implementing these mortgage strategies, we're going to want to do that with the end in mind and get a financial advisor involved to show you what investment opportunities may align with your short as well as your long-term goals. Now, there are other mortgage strategies and other concepts, but we don't have time to cover them in today's lesson. Hopefully, this brief video has given you some insight into how you can build wealth with your mortgage. Again, if it's your first time here, I hope you found value. Subscribe and smash that bell to get notified. I do offer personal, custom consultations. So if that's something that you're interested in, I don't charge any money for that. It's completely free of charge. As long as you're in Connecticut, Massachusetts, or Florida, you can reach out to me directly. If you're not in those states, I can refer you to somebody else, one of my colleagues that may be in another state. My direct line, you can reach me by call, text, or private message, 860-413-3938. As always, I hope that helps. I hope you found value today, and we'll see you on the next episode. Take care.